Have you done any buying of any stocks or anything over the past week?
A little bit of Palantir a little over a week ago, just a little tiny bit.
I can't remember if it was this week or last week that I bought SoFi. It might have been this week. Hold on, let me check my tweets. Yeah, I bought SoFi. I bought 600 shares on June 17th, whenever that was, Monday. But I bought about 4 grand this week off SoFi.
Ladies and gentlemen, welcome to the SoFi Weekly. SoFi's been accumulating some cash. With a depressed price coming in right around the time that they're going to start prepping for their quarterly earnings, do you think that the board might talk about potentially authorizing a buyback for the stock, considering that the money is not going to be used for?
Dude, no way. I thought you were going to say stock split. I was like, whoa, deja vu. Is this last year?
It would actually infuriate me. For one, this is a bank. I mean, it's more than a bank, but it's a bank. And so the more healthy and sizable that balance sheet is, the more that they can loan against it. Now, if they're not planning to make any loans for a while, that's fine. But essentially, what you did is you diluted shareholders by doing senior convertible notes to take care of some debt in order to take money now and then buy back the stock. And that to me makes absolutely no sense. You're hindering yourself long term and in the short term and confusing shareholders and also the market on what you're doing. So they should not be doing buybacks.
Eddie in the chat says an acquisition would be more prominent. What size? What would you like them to accomplish in that degree? I mean, acquiring a brokerage or something?
If he's talking about an acquisition, he's talking about SoFi being the target of an acquisition if they're going up. An acquisition is better if the stock price is higher, if SoFi is the acquirer because they dilute less to acquire the target company. If it's the other way around, if SoFi is cheap, then somebody's going to look to acquire. It's more compelling of an acquisition from a bigger player buying SoFi.
The board will have a pretty sizable argument to say, hey, the company's way stronger and we have been priced like this in the past while interest rates have been in different environments. So I bet they could ask for a pretty high number.
It's just a negotiating thing, right? Like if I was going to buy SoFi and offer them $10, I can't do that if they're trading at $10. I can do it if they're trading at 6.
Anthony Noto, to some degree, and the rest of the board can end up fighting off an acquisition. But if it's priced so well that they might not literally be able to say no, just because it's in their fiduciary duty to do what's best for the shareholders. Whenever I say buybacks, I don't necessarily mean $1 billion or something like this. I mean more along the lines of Marquetta. I think that was a $200 million buyback. And that's a very small company, but still ended up just showing that, hey, we think that this stock is underpriced. Why don't we go ahead and authorize just a program? So you're not even necessarily pouring all that money out, but you're saying, hey, we can have this money if it's available to us to buy it at a price that we deem is reasonable.
The buyback can be absolutely the right decision depending on the financial health of a company. PayPal, case in point, long term, they're going to really benefit from it. But that tends to not move the stock price as much as when it's from a place of strength. Even if you're getting less yield on that buyback percentage because the stock has really shot up based on fundamentals, it still has that psychological, I guess, impact. Dividend even more so. It's confusing, to me as a shareholder, why they would even be doing that, other than just trying to manipulate the stock price, which I don't want SoFi focused on. Yes, do things that will bring shareholder value, absolutely, but usually those are fundamental things. And eventually, at some point, the fundamentals of SoFi will shine through. But what they can actually control and do, like if they really wanted to increase the share price, they could open up the loan book. They could really start doubling down on credit cards and trying to get that handled. They could bring an improvement in the invest platform and start attracting more people there. Manipulating the share price is not what I want them focused on right now.
I really think in the short term, it needs some type of jolt to achieve some price discovery across the board. So people are like, oh, this company is executing. I still think it has that X-SPAC moniker, like a dark cloud following it around. I still think it has a lot of people doubling and tripling down on the bearish aspects of it being a bank. There's a lot of aspects of the business that people are discounting for SoFi because we, on the bullish side, are maybe over indexing on the growth and the management execution, and the bears are under indexing on that. And that's like the biggest difference. Next year, SoFi is going to have a bigger percentage of their revenue in non-banking aspects of their business. The year after that, it's probably going to be even bigger than that. And so eventually the narrative is naturally going to change where it becomes completely unreasonable for people to focus exclusively on the banking side of the business. Whereas 2 years ago or 3 years ago, yeah, the lending side was obviously all you focus on, right?
Do you guys think that the lending percentage of total revenue will swing back? Maybe not to the degrees of 80+% of total revenue, but maybe back towards the mid 60 percentages after we've hit 50.
I think that would be massively bullish because for it to do that, you would have lending just exploding in terms of growth because it's not like the other segments are falling or contracting. So for lending to be 60%, it means that it's doing that despite financial services growing 80% and despite tech platform growing, 20%.
Before we were entering this year, like Q4 predictions, I believe, I said, student loans, I didn't think that that segment would grow very much at all. It ended up that I was right. I know students fairly well just because of where I previously worked in that psychology. Now, in my mind, they would have cut maybe a couple of times. By October is when the penalties really start hitting home. Are we thinking there's going to be a bump then when people are getting close to that penalty deadline, or just there's no real reason to refinance those because interest rates are what they are?
Yeah, I'm sort of in that camp. Like when we made those predictions, it was a very different rate environment expectation. That is a large driver of student loan business coming back, of home loan business coming back. If that rate expectation is delayed 6 months to a year, then those catalysts feasibly would be delayed by the same amount of time.
Back then, we were thinking rates were going to cut in March. There was like a 96% chance on the Fed Watch tool that they were going to cut in March.
I don't know that we'll see a huge spike. People will have no real reason to refinance unless it's possibly just to lower that monthly payment or something like that. And there'll be a few of those, it won't be nothing. What interests me is when rate cuts have actually made an impact. And this might be a year and a half, 2 years out. We don't know. There are a lot fewer players in the student loan market right now. Discover bowed out, and there's been a couple others as well. And so this is a market that, it's SoFi's bread and butter before COVID, and it absolutely can print money. Like they've handled this business very, very well. It grew SoFi into what it was able to do there despite everything in COVID. I don't think that Q3, Q4 this year, barring some crazy rate cuts, that much is going to happen. But in the future, they're absolutely going to do well in this segment, like very, very well, probably better than what they did before COVID. Especially looking at some of the rates that people are paying right now. When those students, let's say in 3.5, 4, 5 years, get out of college, hopefully will be at normal interest rates, not like 0% interest or anything like that, but something like before COVID. If that's the case, there will actually be a legitimate reason to refinance at that point. And I'm sure there'll be other people wanting to get their piece of the pie, but it's not a winner take all thing. So
overall, if that turns around, they are going to do very well in that market. It's not one to heavily bank on. I think that the very exciting part is that was SoFi's exclusive business. So now that everyone is sort of pointing at personal loans and saying, hey, this market might not do as well, I like to point at the history of SoFi and say, hey, why do we think that this is going to be their key driver going forward? Right now, it's seeming to really shift over to SoFi Money. And I think that a lot of the people who are putting these lending margins on SoFi saying, hey, there's a ton of risk to this company and they're making the bulk of their money this way on interest income through lending. I think they'll be shocked if SoFi Money can continue to grow the way that it's growing and cross-sell at near $0, to other products and expand that lifetime value of their customers. So they might be getting to a healthier part of their business right now just because of the market that they're in. Anthony Noto knows how to grow in the environment that he's given, even though they have not been given like a sort of green light in 2.5, 3 years.
Derek White is amazing. This is a really good clip.
He's just sort of talking about the future of banking, which sort of companies could be in threat versus ones that may survive, and sort of the challenges that he thinks that these traditional banks should try to address.
And the number one thing, because you're CEO and or chairman, especially if you're publicly traded, understand how many P&Ls do you have in your business, and then go back and measure how DIY. Number one, go back and measure how DIY your business is. It is super simple. Take the top 50 reasons why a human walks into a branch. Take the top 50 reasons, top 10 reasons why a wealth customer contacts your wealth management business. If you're a corporate banker, what's the top reasons why your customers are contacting you? Is it because they want to, or is it because they have to? Start with the top 10. It's super simple. Top 5 sales, top 5 service. Are they contacting you because they want to, they have to, or is it DIY-able? Because if Google came in, took over your business, do they look at it like Google, or Zuckerberg comes in and takes over your business, flips your business on the head and says, if I were to design this with 0 humans in the loop, 1 human above the glass, 0 humans below the glass, what does your business model look like? Because that's where we're heading.
there is a lot of really strong statements that he makes in there. Tevis, is there anything that you thought about from that video there about Derek White talking about sort of tech maybe displacing some of the traditional banks?
I thought about it a little bit differently. You have to break down from a first principles perspective and reverse engineer the aspects of your business to look at all the raw inputs, essentially, in terms of, okay, how do we create that moat for ourselves? And then how can we lean in to what our competitive advantage is relative to the market, and what niche can we as a result carve out in the market? And that exercise, I think, is really interesting in the lens of also in SoFi, because they have all of these different business segments. The ecosystem therefore becomes the moat. It's because they have everything all in one place and there's interoperability between those product lines. And that provides a really powerful value proposition for the end user that they can't find anywhere else. I think it's just an exercise just to keep grounded of all of these businesses that they have to do in terms of finding what the profit drivers are of the business and leveraging those to deepen that moat in their market.
There's a lot of competition in the sector that where SoFi is, and it's sometimes hard to get a grasp on how good Galileo and Technisys are, how credible their tech platform is. We'll find that out in the pipelines and the bidding, what's going on these projects with the mega banks. But APIs are absolutely the way of the future. That progression of that physical to electronic to just in the cloud type banking it's inevitable. SoFi will benefit from that, and a really interesting way of looking at things. And yeah, I'm glad that he was retained when the buyout of Galileo happened.
Very strong speaker.
I've been confident in the tech platform, but it gave me even more confidence with him being the CEO of Galileo there. It's like
credit card's tricky, right? We know it could be massively profitable, but it has this inverse relationship. You're either going to give the benefits to the members and have lower profit for yourself, or you're going to have more profit and have lower benefits, which makes it less compelling of an offering. In the context of they're already investing like 100 million into this segment. This segment is already not very, big from a contribution perspective for their, profit. It's not making money for them. There's high delinquencies. They're getting that under the control. I get it. But if I think about like a refresh on the credit card aspect, I'd really need to see what that looks like from an offering perspective and from a business benefits perspective.
I don't think it'll necessarily be a refresh. I think what he meant is more of along the lines of a premium card. Yeah, it's crazy. If you guys look at the statistics on SoFi's interchange revenues, just from their debit card that they have with SoFi Money, it was unbelievably explosive. Okay. We have to remember one of the highest ROE products that any bank can offer is a credit card. SoFi does not have great underwriting for their credit card currently. It's trending in the right direction, not perfectly, that we have seen some ups along the way, but trending in the right direction. Having a checking and credit card relationship is peanut butter and jelly. I mean, like, look at Nubank. They've been able to cross-sell it in, with perfection. So the future is there for SoFi. They're building up the checking account people. Now they just need to make sure that their underwriting is fine and that they can give out their credit cards to the people who are actually going to pay them back. Eddie, good to have you back, man. We had you on a little while ago, but you've been recently looking a lot into SoFi. What are some of your key highlights that you want to see going forward from Noto?
Just looking at guidance, the first half of 2024 is very slow growth, but when you look at the back half, it accelerates really quickly. If you take their guidance and then subtract out guidance from Q2 and what they actually achieved in Q1, if you take the high end of their guidance, they're going to achieve around 640 million per quarter if you average it out over both quarters. Now, it would probably be less Q3 and more Q4, but we're going to get a big acceleration, and I don't think the bears actually expect that to happen. Then you've got tech accelerating into 2025 and 2026, lending accelerating into 2025 and 2026, and then financial services supposedly decelerating. But Anthony Noto was very clear that the 2026 guidance was not including a broader credit card portfolio, and they have specifically said that they are going to innovate in the second half of 2024 on the credit card.
Yeah, but that's going to be a negative though for 2024. It's going to take more than it gives in 24. It's probably going to give more than it takes in 25 and beyond.
I think it'll definitely be a boon for revenue. We'll have to see how it affects profitability.
A lot of it is actually variable cost on the credit card side, where it's a lot of fixed cost on the invest side. I believe that the invest side is going to continuously get better over time, whereas the credit card side was doing this amazing thing of coming down off of some pretty devastating default rates for the last little bit, really falling off. It was looking like they had made the right correction. We're heading right back down to standard default rates across the industry up until the last quarter, where it just slightly ticked up again. Not a lot, honestly, but even if it was flat, I still would have been a little bit disappointed, just because we haven't quite hit where we should be just yet. So for it to start fluctuating again seems early.
Credit cards are hugely profitable. If done right, it's something to really look forward to. I think they're going to come out, either they're going to completely alter the current credit card, or they're going to come out with a second credit card that's different sometime in the second half of the year based on their guidance. Chris Lapointe in his Mizuho interview said that they've got the unit economics where they want them. And so I think a lot of the default data was them testing different things. Mid Q3 is my current thinking. Credit cards go through a J curve where there's a lot of, a lot of people take money and default pretty quick before they become profitable.
I was hearing all these stories about how people were getting cut off, their credit card limits were getting bottomed out, and all of these things, like SoFi was starting to get very selective, but then the lowest FICO range climbed again. And I'm like, what the heck is going on? Like, I don't and now FICO doesn't necessarily translate to losses, but it's a pretty freaking good indicator, so
They have to get it right. I think that they will. They talked very positively about it. Sometimes we investors can fixate on one quarter. That's a small sample size. It's dangerous. A lot of one-time things might have happened, or just some noise. If we start seeing a trend, it ticks up again in quarter two, then yeah, it's a concern. For now, it's just a blip. I don't read too much into it. It's hard to get a read on exactly what they're tweaking, what they're changing, because there's some. I actually was looking at the earnings call transcript, and they mentioned credit cards a lot of times, and specifically that $100 million loss. So they're working on it. They're trying to do a few things, but the word that they were using was eventually. Eventually, to me, doesn't read like quarter three this year.
I'd be curious to see how this credit card, or if this credit card, plays in their ecosystem. I mean, to my earlier point, like, that is their competitive advantage, is that ecosystem. And if this is a credit card for premium members, or some type of new offering, or whatever it may be, leading into that ecosystem, I think it's going to be really important for them for the lifetime value of their cohorts.
Can we talk about the invest platform? I see criticism about SoFi's invest platform all the time. I do not see why SoFi gets so much criticism for their invest platform, specifically because 98% of people that I talk to about stocks at work or whatever, like, none of them are trading options. And so I don't know why X particularly is so hung up on SoFi getting options. I don't think it's that critical to their success in the invest platform. And
it's because all the people who do trade options are on X. And so they get a disproportionate voice in that particular medium.
You're talking directly to the 2%. The one that I always compare it to is my girlfriend. She has a pretty sizable investment portfolio, but nothing crazy. It's all in managed investing portfolios. And I think that is really their target audience. They're trying to, get in good with audiences that Robinhood is not targeting. And Robinhood could say that they're targeting more of a female audience because they sponsor one WNBA team. But the truth is that's not cutting it. And that it's a highly male dominated area. But there still is a very large percentage of the total wealth allocated into different genders and different types of investors. And that could be a much more passive investor. The only thing I'll counter that, and the reason why it's important, is that if you do look at brokerages like IBKR or Robinhood or Charles Schwab, options make up for a large percentage of the revenue. Although it's not maybe the majority of people who use it, it can make up for the majority of the actual earnings.
The other part of it too is when the invest platform was fairly new, there seemed to be a lot of tech issues that were very frustrating. If that's your main investing platform, you need uptime. You need it to be reliable. You need it to be easy to use, and you need to have a reason to actually transfer your assets from one to another. And SoFi is not given that.
There is market leading, and then there's good enough. And I think right now they have so many plates that are in the air that they're juggling, that good enough is good enough for them. They're going to focus on having the entire ecosystem and then circling back to say, okay, what do we want to double down on?
This is never going to be one of those main leading segments of business. For even in a raging bull market, I just don't see it. It's just one of those little things that adds on to their platform.
I think that people, especially from an investing standpoint, point to potentially SoFi's weakest product and say this entire bank sucks. Where the people who are looking to use its credit card, its checking account, Relay, basic banking tools, it is potentially the best product on the market.
I'd be surprised if it gets to 550, though I think it's totally possible that it could get to 550 or lower. Anything below 5 is like a fire sale. Tangible book value right now is guiding for another 200 to 400 million in tangible book value growth. So that should add 20 to 40 cents of tangible book value before the year's out. Then you've got the credit cards launching with high ROEs. Tech is accelerating. Things are looking good, and the stock's not looking good right now.
You know, there's an argument by bears that this is just a bank, which I don't think so. I strongly disagree. Otherwise, I wouldn't be in SoFi. Then it's typically judged on the price to tangible book value. Tangible book value of SoFi per share last quarter was $3.92. Bank of America is at 1.61 price to tangible book value. And SoFi, if it went all the way down to like, I picked $4.95 as just an arbitrary number. You know, if we were at $4.95, we'd be looking at a very low price to tangible book value, assuming that SoFi really was just a bank and ignoring the growth. It's stupid at that point. Like it's already, I think, cheap right now. Cheap can get cheaper, but there's a limit to it. And at some point, like even the bears will be like, okay, this is just a bank, but it's valued as like it's going out of business. There's a point where buyers will step in and they'll just be like, this is absolutely dumb. I know people that are not even that excited about SoFi that have bought. There's a point, tangible book value, I think, is that floor for us, barring World War III. World War III, all bets are off. Alien invasion, all bets are off.
The reason why I'm still buying, so the further it falls, the further it's de-risked in my mind, because it's not falling as a result of any lack or gap in fundamentals. It's falling as a result of market whims. And yeah, thanks. I'll take the extra difference in opportunity that we could have later on down the line.
SoFi under $5. It is outside of a black swan event. Is that happening? Yes or no? End of the year.
Look, man, we're like $1 out of the breaking under the $5 range. 2 weeks ago, we were like at 7. In another 2 weeks, yeah, for sure we could be at low 5s. It's very possible.
I think it could go below 5, but it would take some kind of big macro event. I have a tough time even seeing it get to 550. Like, I mean, I do think that's in the realm of possibility, but we're already really far oversold. And it's happening to all of fintech. I mean, like PayPal went up to what, 67 and is back down to 60. It went below 60. Like, this isn't like SoFi specific. And I see a lot of people acting like it's SoFi specific.
I don't know, man. You guys attribute logic to short-term price movement, which is totally rational, and I would do the exact same thing. But if I were standing here 3 weeks ago and SoFi was in the mid $7 range, and I said to Roy, hey, how likely do you think we are to break below 52-week lows at $6.20 in the next 2 weeks? You looked at me like I'm crazy. Now you're thinking, oh, well, there has to be some massive negative catalyst for us to break below 550. No, there doesn't. There needs to be 4 red days in a row, or even 2 red days in a row, and there you go.
All in all, the stock is going to continue to add new members, continue to strengthen itself as a brand, bring up that brand awareness, and hopefully cross-sell and increase the LTV and potentially retain a lot of earnings. Whether or not you as an investor want to continue to hold or you don't believe that there's a turnaround play is a decision for you. Ladies and gentlemen, thank you all so much for watching. Really do appreciate your time. Unsubscribe to Tevis's channel. Bye for now.